Look at this run here that AMD has made just finally yesterday, crossing $500. And in this video, we're going to go into the next stocks that are going to make those AMD type moves and where all of the money in the market is going to be rotation and what's going to happen at the effects of this war going on. So as right here, you can see we're going to talk about where is AMD going, what's going to happen whenever the consumer sentiment gets better, what sectors are going to benefit from the end of the war most and give you those 100% gains over the next few years, and what is going on with Salesforce after their earnings today. Were they super bullish or what are we talking about? So first off, I just want to go back and talk about AMD. Where's the stock going? Whenever semis go, they go big. And the good thing about AMD is they have deals with Meta, OpenAI in the future for this revenue. And basically the total addressable market share of their whole market, that's going to $1 trillion by 2030. So they need 10% of that and they do $100 billion in revenue at a 30% margin, $30 billion of net income. And then that's how you slap on your ratios. That's how you get their whole market caps. And that's how Wall Street and everyone moves. So that's sort of thing about it. That stock's just going up and up because they're finally catching up to NVIDIA and everything in this trade. So yeah, if you didn't want to buy AMD today, but you're like, okay, it's ran 400, 500% in the last year, all the way from $80 a share at the start of last April. You know, that's fair. That's fair. But if you're not going to buy it, you should be looking in other areas and you shouldn't be trying to fear missing out getting into these trades. So AMD, this stock's going to $1,000 plus. Pretty simply, plainly as that. The stock is getting to 1,000. And if you remember, whenever you want to be buying into these stocks is whenever the market's getting beaten down. Nobody wants those names. No one wanted AMD last year. No one talked about whenever it was just at the lows. And we're saying this is our number one stock. Buy, buy, buy. You can go back, watch all of our videos, all the depth and analysis. And one of these stocks here today has such resemblance at the end of the video that you're going to want to see. And pretty much all of these have different characteristics of AMD, the way that they're treated and the way that people look at them, that gives them so much upside coming soon, no matter what the market could do. So that's that. We're going to go right there. That's good. We're pretty much done with that part. And then the next thing is, what happens whenever consumer sentiment gets better, right? So look at this poll. So basically, even you see at the April lows or the COVID, they never even got that bad. The only time it got way worse was starting in the middle of 2020, end of 22-ish, right? So basically, just think about the consumer's been in the dumps and just think about what stocks in the market have maybe not been performing great because the consumer hasn't been there for the last few years. They haven't been able to spend money because you could almost argue, hey, we've been in a rolling recession because no one can spend money because inflation's been so high for the longest time. I mean, the housing market, you can't even buy a house right now. We're going to get to that at some point. So basically, what's going to happen, do you think, these stocks is if the consumer sentiment is the worst possible, people are going to go spend more money. If you think they're not spending money right now, eventually once this gets better, imagine the inflows into these types of stocks and companies. And this brings us to our next point. The consumer stocks are trading at great financial crisis bottoms compared to the S&P 500, right? Same as COVID. So basically, people are selling off these stocks because they think the consumer is getting hit so hard and they're not able to spend, that these stocks are so sold off compared to the rest of the market. Which means if these stocks are so undervalued and everyone's chasing that AI trade, where is the money going to be flowing eventually once AI kind of hits a peak or a breather for a moment and these other stocks are starting to make nice moves? That's whenever you're going to get that swing. That's where you're going to go and find your stocks. And it's important that whenever everyone's talking up AI, right? You were buying these stocks last year, the last 2 years, whenever no one was really talking about a bunch of these. And then now it's shifted where those are the big ones in the market. And now no one's talking about them. They're hating them. They're the most hated stocks ever. I hate this stock. I'm never going to buy it. And then that's the swing of thing that's going to happen, right? So basically, we're going to go, opportunities like we've shown you there, right? They're going to be in these consumer stocks out here, right? That's where you're going to see these opportunities. And we're going to take you through it. And also the war, right? Once this ends, that really relinquishes a lot of those fears because what do we know about the war doing? Oil goes up. What does oil do? It's in the GSG, so that makes inflation go up. What does the Fed have to do whenever inflation goes up? They're going to hike rates. So if oil goes down, less inflation, and it doesn't get past their core, they can cut rates. Lower rates means you can more people are employed. Lower unemployment, that consumers are better off. Less inflation, more real wage growth. Consumers feel better. They spend more money, and they get the economy going. So what areas are going to benefit from an end of the war, right? Like we said, consumer discretionary, Celsius and Elf, growth stocks, AMD, Zeta, ServiceNow, Hims and Hers, all going to have money inflowing them because we're going to get to that later. Financials, SoFi, we're going to get to what that is soon. And housing stocks, who've been just distraught because rates have been so high and they're not that 0% that people got fixed in at. So let's go there. Like I said, higher gas prices, people have to spend money on gas. People can't spend as much money on essentials, or essentials are higher because of higher inflation. And the companies are going to have to sell products for higher, which can lead to less revenue and less spending on them. And the companies are going to be forced to keep prices lower while paying for higher production fees because no one can afford the products, right? So then this erodes their margins. And what do you know about stocks that margins go down? Like people are worried about Nvidia. They trade at way lower valuations because they don't have pricing power and they can get taken out of the market. So that's what you're seeing in the lower share price. And just two examples of this. Look at Celsius here was about $60, right? Down to 30. So this stock was, I think I can put it in here, right? $60, you're getting a stock. And this stock right here, right? 60. And now look at what it's trading. It's 60 and now it's trading all the way down to 30. Okay, so look at just how much this stock right here, ELF, 100, it was up at $140 stock was ELF, okay? And now it's trading at 57. We just told you guys to buy it after their earnings at $50. And look at this move it's already made. Look at this little jump it's made. But look at this, and this is just in the last 2 months these stocks have gotten hit. Because everyone's worried about the war, the products. But if you go through and look at deep in our other videos, they always beat on earnings. They smoke earnings. In Wall Street and everyone's panicking to where Wall Street and then we're going to say, hey, AI is not working. We're going to have to rotate the money right to these stocks. And they're going to have great earnings in the face of whatever the economy is. And you can even see like Celsius in the April, that thing went up the whole time, right? Before even those lows. ELF in 22, ELF bottomed in 22 around May. The market went down to October, kept going down 10%, 15% more. ELF was flying up almost up a crazy amount during that time. So that's why these consumer stocks, that if they're going to put up their numbers all the time, you're going to get great deals on them. The next stocks, I said, growth stocks, right? So a higher rates, right, means there's less confidence of people in the market. And since growth stocks are risk on assets, so like say you're really confident, right? You're going to be like, okay, I want to buy the stocks that are going to be huge returns that maybe are a little bit more riskier than other stocks, but I'm not just going to get okay in the market or underperform it while the market's flying up. So that's where people are going to go rotate money into growth stocks. And then whenever interest rates get cut due to lower inflation, this leads to more confidence the markets can go up because it stimulates borrowing activity. In lower interest rates, right, because of lower inflation, they mean lower treasury yields. And basically that means more liquidity in the market. Because say you can get 4% in the treasury, you're like, okay, that's okay, maybe I'll take that money. But if you're only getting 2%, 3%, you're like, I don't know if I can lock my money up for 10 years, only get 3% a year whenever the market can do this amount of money. So basically, you can loan more economic activity spurs them, and more economic growth. So that's why growth stocks are going to fly whenever you have lower inflation. Financials, right? So yields are going to be tracking what inflation expectations are. So if you ever want to know what the 10-year inflation expectations, for example, are, you look at your 10-year yield and you subtract it minus stuff called Treasury Insurance Protected Securities, where they're basically bonds that you basically get a set rate above like inflation they're going to do. So basically you can't lose money on your bonds. If you think, hey, more inflation is going up, I want to be in bonds. So a good way to find out the inflation is, say the 10 years at 5, the tips are at 2%. You could say, hey, they're probably at 2.5% because maybe you're getting 5% extra yield. So that's why 2.5% would be your inflation expectations. And usually yields going up are good for financials because they have an upward sloping yield curve. And because they borrow at short term and they loan at long term, they make all that profit in between. But they're taking a beating because if rates are going up, they're worried that companies are going to start defaulting and not able to pay back on their loans, or they're not going to be able to refinance at higher rates. Because a lot of these companies were getting loans at 0% in 22. So that's why the dangerous thing is. And also private credit is a huge crisis. We have great videos of that on the channel. And if you borrow at a fixed rate at 0%, you're like, okay, but these companies didn't borrow at a fixed rate. So they're paying extra and extra the more it goes up. And basically, if the war ends and oil goes down and inflation, then that's extra loans and extra economic activities for the banks. And then A great stock that we love here that's been beaten down so hard, right, is SoFi. Look at them. They were $32. They're down like 50%, even though their fundamentals underneath them got even better. Their CEO has over 70% of their net worth in them. It means they're smaller, and the way they do it is they do a lot of fixed. So basically, you go and they do a fee-based loan instead of holding on their balance sheet. So this is going to lead to them actually being able to be protected in a recession or anything. And then it's going to lead them to fly up so high because this stock rips, right? It was $8 in April last year. It got up to 32. So whenever the market is like, okay, the market's good, this stock flies and flies, and their fundamentals on the surface are getting better. They always be an analyst, and they just didn't up their guidance because they don't know if there's going to be rate cuts this year because of the war. So if there's any rate cut, then they do so much better than people think they're going to do. So we have them like $75 plus stock in a few years, right? And then circling back to these, $150 stock for Celsius in a few years. Elf Beauty, over a $200 stock. So you're getting great returns on all these stocks right here where our bear cases aren't that bad. And then housing, like I was saying, because rates were 0%, everyone was moving in 2021. They had highs. Now the highest rates for the longest time in years because people refinance at 0%. So now they're saying, hey, I don't want to get rates this high and I'm not going to move. So what does this do? If people think that rates are going to go up, and there's less supply people moving and less supply people selling, these companies don't get as much business. And then basically prices are going to go sky high for housing because people don't want to move. They need a big premium because they're saying, hey, if I'm going to go refinance at these way higher rates, I need a lot of extra money. So if you get oil down, you get inflation down, you get rates down, this stimulates people to move and get a new mortgage. And these companies like RH, who were at $700 at the 2021, now they're trading at $143 because no one's moving. They could fly back up. So housing stocks are a huge beneficiary of anything that happens in the market. And then all of what you guys have been waiting for today, Salesforce, right? They come out, blow out earnings, right? EPS, we're going to show you how much they beat by. And they're still down 0.57%, which for them is like bottoming because usually the SaaS stocks report great earnings. They're down 15-20% is what the last quarters have been. So I think a bottom might be in sight. And I'm just going to show you these numbers for them. Does this look like a company that should be down from $260 to $177, down from their highs at $350 like a year and a half, 2 years ago? Whenever this is what they're doing with their revenue, look at this, up and to the right. Look at to their EPS is up and to the right. Look how much faster that's going because they're doing 10% of shares year over year, 114 million shares repurchased, 50 billion of authorized repurchasation, largest ever. This company's buying back shares like nothing. They're buying back because they're like, we're so undervalued. We have nothing to do with all this money. They're buying back and they're investing in AI. And I'm going to get to you what does their AI do and what's actually how AI is going to be a beneficiary for them, right? So look at this historical P down while all of this other stuff up and to the right, which is exactly what you want to see because you see companies that their fundamentals are getting better, that if you're saying, hey, they're still innovating, they're not going to get disrupted by AI, that's the important part for them. And look at this EPS and look at this surprise. 24% they surprised by this quarter. 24% where they beat almost always on revenue, maybe a little bit of a loss. 25%, 13.5%, 14.1%. And they just went and they raised their EPS full year guidance by one single EPS. So they went from 13 EPS to 14 EPS. And look at how much they beat. They've been beating by like 0.75, 0.40 a quarter. So imagine what they can actually do in a bull case if they have these crazy beats for their share price this year. And they don't even have to be trading at a high PE ratio. They're trading at a forward PE now of genuinely less than 12 at this point. A forward PE of 12 whenever they're going to be growing revenue and net income at double digits. How is that fair for a company? And they don't look like a dying company. Look at their business model, right? Just for if you don't know anything about them. Say you're running a tiny lemonade stand, but you easily forget your favorite customers, right? But whenever you're a massive company, you can't remember people. It's impossible. So they have a problem. They're going to call Salesforce to get this. Salesforce basically tracks every single interaction. So this customer does this, it remembers that. This worked with this other customer, it worked with them. So they remember and they tell you what you should be doing. They handle anything that comes up. They can answer questions, which I'm going to get to. And the companies, they pay a monthly fee in the SaaS model for every employee. So as it grows and they hire more people, Salesforce automatically makes more money because they scale up within these companies. And basically, you have to get better in AI and new versions. So say you pay for one or two of the versions, you're like, okay, I want the best and best. So then you're just going to be spending more and more money as a company with a recurring revenue model to something that AI can't even go do because Salesforce has all of your company's data, right? So basically, you track all these customers. What happens if you leave them? The AI just doesn't have that data. Salesforce has to, so AI has to go and rebuild all that. Over years and years, they may have been integrated. And then you're going to have to pay a high switching cost, billions to even build something. And then also, all of your functions are running through it. They're scaling every single part of the company. All your employees are trained to use it. And is this easy stuff to switch off for a company? You have to ask yourself. For them and companies like ServiceNow that store data and are so scaled inside companies, there's going to be a high, crazy switching costs. And you just can't do it. You're going to set your company back for years. Are you going to retrain your employees, lose your data, and spend AI model? Whenever Salesforce even has this AI agent called Agentforce that has a crazy amount of use case and helps their customers. And I just want you to look at this. Look at what their annual revenue did, surpassed the $1 billion mark with triple digit year-over-year growth. So it's growing over 100% year-over-year Agentforce. This AI companion that helps customers on there all day and acts like a basically autonomous digital labor. So it uses Salesforce to store data to go help companies. There's 24/7 customer support, so it can answer questions that customers have, and it will search through the databases, all the information they have. It's going to go through website leads to help people market and advertise. It's going to book meetings. It's going to build customer lists, draft emails, and do ad campaigns. So basically, this is all the stuff that humans could do. And that's the whole argument point that Salesforce and ServiceNow are actually going to benefit from AI, as like their CEO said, because say these companies, they're not going to want to leave the platform. So they just build agents to help the companies do this instead of having chat or Claude or someone go and code agents for that company. So that's why that these stocks are such a good buy, because they have this moat where you can't switch away. There's crazy high costs that even if AI could do it, why would you do that to lose all of your data? And just to show you our projections using Fort Gamma right here, we have our free beta out. So where you helped us, and you can go and use all this. You can do your research on your great new features coming. Just fortgamma.com, put in your email and everything. But basically, they're growing revenue 11%. You get the snapshot, you get the analyst targets now. They're going to get raised because they just raised their guidance. And you get your bull case, bear case with your CAGRs, which look at this company. So say they're going to do EPS of 14.18. So we're not even saying they're going to beat any times the rest of the year. They're just going to do what they said they would, even though every quarter they've been beating by like 20%, as we showed you before. So we have them just a 21 to 26 forward P, which this is crazy because we're showing that it going from non-GAAP to or GAAP to non-GAAP. So that's why it looks insane. But basically, their forward P is trading at 12.5, just with this minimal growth. They're buying back a crazy amount of shares, and they're only trading at a 21 to 26 trailing 12 price to earnings we have, which is way under what their old valuations used to be. And they're giving you a CAGR of 30%. They're just getting to $63 billion revenue like they said they would, and literally by end of 2030. And this is basically saying like 29 because they're already in their fiscal year. So this is the end of 2029 they're getting to this. They're doing almost 11% revenue growth a year, 2% buyback year, which is probably going to end up being low. So their EPS might even have bigger and bigger moves. They're getting to a $500 share price, a 30% compounding annual growth rate year over year from this point. The best part is their bear case. They say they do 8%, around 10%. They buy back not crazy amount of shares because they can't. They're trading at a PE ratio of, while they're growing high single digits and low double digits earnings per share growth as a company, they're trading at a price to earnings ratio of only 15 to 20, way under where the market is. Even though they're growing at a bigger clip than the average market, they're having double digit earnings per share growth while still having pretty significant revenue growth. So this could be crazy. Say that we're low and they could be trading at a 20 to 25 P, then you're getting a 20%. So, but we're just being conservative right now. And this is what you kind of want to see in your companies, that if you can be super, super conservative and still get a better return in the market, you're like, okay, this is a great opportunity for the long term. And their bull case has them just blowing the stuff out. These Agentforce and all this AI really takes off for them. They grow at 13%, 18%. Their buybacks aren't even anything insane, right? Their buybacks could be, I mean, they're probably, let's just say our bull case should probably be like more like a 4s. And base case, we could say they're more like a 3s right here, just to even get you better prices. I mean, you're getting crazy numbers here. You're getting a 50.5% CAGR, trading at a P ratio of just 30, trailing to a month, which is just a little bit better than the market, while you're growing at almost a 20%. You're growing at over a 20% EPS clip. Revenue growth is double digit. And like, look at this is exactly where they could be. They could be almost a $1,000 stock by the end of 2029 from less than $200, over a 5x, like a 6x with your money. So that's what these SaaS companies can do, because people don't want to buy them. How do you have a company trading at a 12.5 forward price to earnings ratio whenever they're still going to be growing double digits and their EPS is growing at like 15% maybe a year? That's crazy. So that's what Wall Street and everyone's missing on this. And a lot of times, I was watching stuff that the companies that build out all this AI, they don't actually reap all the benefits. It's more other companies around them that innovate and use the technology that actually are the ones that reap it. And the companies like ServiceNow and Salesforce, they're taking measures to use AI and integrate it with all their services and everything. So that's why they're going to survive, which all SaaS companies, some of them might not survive. Like, don't get me wrong, but others are going to prosper and might even be the most prosperous from AI. So thank you guys for watching. That's all I have today. Leave comments if you want to hear about any other videos, and make sure to like and subscribe.